Hi everyone, this is Jamie Fleming back with yet another financial analysis video about UPS. Please see the first two videos for background. Ever since the first two videos went public, I've gotten a lot of feedback and questions from Teamsters across the country. A lot of the same questions popped up several times, so I'm here to answer those for you all now. First up, people wanted to know why I excluded the international package segment from my analysis when it's Brown that picks up and delivers those packages within the United States. I want you to know that I definitely considered this question before I even made my first analysis video, and looked into the accounting for each of those divisions to make sure I wasn't making a mistake. And here's what I found, which justified my decision to focus on U.S. domestic package. If a package originates in the United States and a UPS driver picks it up, the revenue and operating profit go to the U.S. domestic package segment. Even if the package is going to China and has to go on an international airplane ride and then be delivered by a UPS driver on the Chinese mainland. But at the same time, if a package originates in China or anywhere outside the US and then gets delivered by a UPS driver in the United States, all the revenue and operating profit from that package will be attributed to the international package segment. In practical terms, you can see how this ends up working out. Domestic gets credit for packages going one way, international gets credit for packages going the other, and it all cancels out and has no meaningful impact on the trends demonstrated in the first two videos. The operating margin trends I showed you still hold true for the segment that you all work in. Another question I got a few times was about major acquisitions like Coyote Logistics and the failed attempt at buying TNT Express several years ago. The question here was essentially, if UPS is spending all these vast sums of money on buying other companies, doesn't that make the charts look worse and make it appear that they have less money to spend on a Teamster contract? And this is a great question, but the answer is basically no, because that's not how the accounting works. The only impact these big acquisitions have on the income statement at all is that they may lead to higher interest expense if UPS took out loans to finance the acquisition. But in that first Q&A video, I addressed the difference between operating profit, which I focused on, and net income. So if you remember that part of the video, then you'll remember that interest expense actually shows up on the income statement after operating profit has already been calculated. It is not a part of operating expenses. So if I remind you of this chart again from the first video, you see that since costs from acquisitions do not show up in operating expense, that means that acquisitions, whether they are successful or not, have no impact on this chart. Next up, if UPS's finances are so bad, why is CEO pay going up? This is a great question, and it's one that makes all of us angry, including me. Why? Because CEO pay is definitely going up. It's going way up. This chart shows CEO David Abney's pay from 2009 through 2017. The black line on top shows his total compensation, which includes stock options and all that. This line averaged a 20% increase per year since 2009. And the blue line is just his cash salary, which has also grown sharply, with an average increase of 14% per year. This dramatically outpaces UPS's profit growth, stock price growth, and the pay increases for anyone else at the company. And you guys are right, that is not fair. And since I am nothing if not consistent, let's take a look at that U.S. domestic package segment again, since that's been my focus. Here's the pay for the president of U.S. operations, Myron Gray, who just retired in April of this year. We only have his pay data from 2014 through 2017, but you can see that his total comp went up 7% a year, and salary went up 6% a year, which, granted, isn't as egregious as Mr. Abney, but it's a hell of a lot more than he seems to deserve given the results he's produced in that business segment. So it's okay to be mad about this. I encourage it. And in a second, I'll tell you what I'd recommend you do about it. But first, before we set the whole place on fire, let's put this all into perspective. Your last Teamster contract from 2008 through 2013 cost the company somewhere in the neighborhood of $11 billion. Over that same time period, CEO David Abney took home $6.943 million. So why can't UPS give you more by paying him less? Well, because even if his pay were reduced to $0, the impact on the budget available for you guys would only be 0.06%. It's a drop in the bucket. So look, if you're mad about Abney's pay, listen up, because here's what you do. First, you buy UPS stock, even just one single share, and then keep an eye out for the date of the annual meeting of shareholders. UPS holds theirs each year in May in Wilmington, Delaware. As a shareholder, you have the right to attend that meeting, and when they hold Q&A, which they will, you can grab the microphone, look David Abney right in the eye, and tell him what you think about how much he gets paid compared to how much you get paid. Teamsters frequently attend these meetings, so if you're nervous or want to hook up with some friendly faces, let me know and I'll get you in touch with the IBT folks that generally go to these meetings. Trust me, this approach will be way more gratifying than punching yourself in the face and hoping David Abney says ouch. All right, next question. Why do some investment analysts have a buy rating on UPS stock? I've gotten this question several times, always with a little bit of a tone of accusation, like I've somehow fudged the numbers to make things look worse than they are. But that's not the case at all. These analysts could agree with every word I've said and still have a buy rating on the stock. Why? Because that entirely depends on what they perceive to be the stock's market value. Let me explain a little better using an example we'd all understand. Imagine you come across this real estate listing. This house costs $1 million. What do you think? You want to buy it? Of course not. I mean, unless it's in Palo Alto, I'm not paying $1 million for this house because it's not worth $1 million. But what if that same dumpy house was for sale for $100? Well, dang, the land alone is worth $100. Tear the whole thing down, rebuild it, and you'll make a fortune. Now it's time to buy. So in this case, the rating isn't so much about the quality of the house, but about how much of that quality is reflected in the price. Analysts will rate UPS stock a buy if they feel that the price is justified by the expected return on investment. In other words, if something is worth more than its market price, you should buy it. And when it comes to our house example, FedEx is the modern new build in a great neighborhood, while UPS is your rich grandma's Victorian that hasn't been updated since the 70s and has mice living in the walls. Both stocks are priced to reflect that. Our final question is a bit of a catch-all. People have brought up lots of other things that they felt I should have taken into account in my analysis, including but not limited to Orion, bad management, the increase in irregular packages, the increase in residential Amazon deliveries, and more. Did I take these into account? Look, there are a ton of variables that go into determining operating margin, and at no point did I intend to imply that the Teamster contract is the sole culprit for UPS's current situation. Some of the things that tug operating margin down are caused by UPS, like the horrible management and low quality of supervisors that you all deal with. We all know it's ridiculously inefficient to be shuttling out dyad batteries to everyone at 3 o'clock in the afternoon, but that's what they do. Some of these variables are also just the environment that UPS operates in. For example, the need to start Saturday and eventually even Sunday delivery at Amazon's behest. I would also include the cost of fuel in this category. And of course, some of the things that pull margins down are caused by our contract. So this is where those annual increases in labor costs come into play. The Teamsters are certainly part of the equation, but we are only one part. Nevertheless, the thing that everyone needs to understand is that even though we are only one part of the equation, all the parts of the equation work together to create this chart I showed you in the first video. Operating margins trending downward for the past 5.5 years. It doesn't matter whose fault this is, because at the end of the day, whether it's caused by Orion or fuel prices or Teamster pensions, it is everyone's reality. UPS is not broke, nor are they almost broke. What they are is on a track that is not sustainable over the long term. That is something everyone needs to remember as they sort through all the competing voices and viewpoints coming at them. I'm not trying to scare you, I'm trying to be honest with you, and I'm going to keep being honest with you because it's the right thing to do. Anyway, I hope you'll keep asking the questions that come to you as you watch all these videos. Thanks, everyone.